Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Cannot stop talking about the precious metals, right? So we're seeing some signs of moderating here this morning, but the size of the losses that we have seen in precious metals and silver, gold, copper is one really for the history books. So let's talk more about it and where things might be headed with James Steele, Chief Precious Metals Analyst at HSBC. He joins us live in our Bloomberg studios. James, good to see you. Happy Monday morning to you.
Thank you. Good morning.
So is this just really about this gold and silver trade being too crowded and people were just trying to get out, or is there something else going on here?
Well, I think you've effectively hit the head on the nail for the immediate reason. I mean, any commodity that has this parabolic rally that gold and silver had, and the new entrants into the market, which they were flooding in, and have been for many, many months now, it really does invite A, volatility, and B, profit-taking stroke liquidation on any news or developments that run counter to gold. And we had a couple of them within a few days. And it really did give us a big and deserved, I think, correction in both gold and silver.
James, you've been at this precious metal game for decades now. Just put it into context, the volatility both on the upside and then the downside on Friday, there's a handful of days saw just extraordinary volatility. Just put that into context.
Well, yes, you're right, and it's extraordinary, and so was the rally.
Yep.
We were talking about gold made a 54, I think, new highs last year,
right?
And people were talking about a new high, and I always cautioned everybody. I said, look, it's not a new high until we go above, in real terms, what it was in 1980. In January of 1980. Gold hit $850 an ounce. And that's about $3,400 in today's money.
There you go.
And they did that in April last year. And then I said, okay, now we can genuinely talk about a new high. We can genuinely talk about a real rally. And the difference between now and 79 was a limited number of buyers at that time, Hunt Brothers especially, in silver, but also a much more broad-based church this time. Right. A lot in it, but the volatility nonetheless. And to look at it this way, we had a swing in a couple of days that was equal to the absolute number that gold was trading at when I started covering it.
Wow, that puts it in perspective, right?
Yeah.
So, it's just when you look at where we've come, I mean, gold topped $5,500 an ounce last week. It's now at about $4,750, I guess, spot gold. Silver wiped out 30% of its value in just 3 days. Do you have a target for gold by the end of this year? Because for many who had their target at $5,500, well, it already blew past that in just the first month.
Yeah, our high for the rest of the year is 55. We have an average, which is almost where it is now, and we're expecting a very wide range. Good news could take us down closer to the $4,000 level. But what we think will likely, the research view is that we have a moderately softer dollar this year, according to our FX people who've been pretty bang on that. And also we would, I think, very likely see a resumption in a greater central bank buying. I mean, they are the ones that kicked off the genesis of this rally back in 2022. If you look at it this way, in 22, 23, 24, almost 1 out of every 3 ounces of gold that came out of the ground went into a central bank vault. Double or triple the average for the previous 10 years.
That's incredible.
Yeah, truly.
So when I think about a commodity, let's just take oil. Prices spike up, they start drilling holes in Texas. What happens when you see gold just spike up? I mean, they don't start digging more mines, do they?
No, well, not in the near term.
Right.
Again, when I first started covering the markets, by the time a group of geologists said, I think there's some gold here, to the time when it went round your finger or your neck, was about 10 years.
Wow.
exploration, big permitting, et cetera, it's closer to 20 now.
Really?
It takes a very long time. It's highly capital intensive. And the low-hanging fruit has been picked. Mm-hmm. So we're going into different regions and areas. What is flexible is recycling. Because gold, unlike oil and grain, is never consumed. It's stored somewhere.
Right.
It's either
around your neck or
on your neck,
exactly.
in a central bank vault, in a vault some other place, in a bar, in a coin. And that's what can be mobilized at fairly short term. Now, what we've noticed is that we haven't seen the response on the recycling side. It is higher, but it's not as high as I would have expected. And it's rather like owning a home. If the market keeps going up, you may refrain from putting your flat on the market. Mm-hmm. But when it comes down a bit, you might then say, okay, maybe we've hit the high, I should sell now. So we may see a pickup in recycling.
I just wonder, outside of investors, what is the larger impact on the economy? The fact that we have gold prices, and we do use gold in different ways every day, gold and silver prices being as high as they are, even despite the pullback we saw recently, they're still relatively high. What is that impact on the broader economy?
Well, it has been good for jewelry, simply put. Mm-hmm. Jewelry is often about 50% of physical gold demand. We calculate that last year it was only 35%. It's been down double digit. Also, there's a reduction in coin demand. But generally speaking, gold does not have huge macroeconomic impacts. It reacts to macroeconomics. Right. It doesn't set. It's not like oil. It doesn't set the stage. It reacts to the stage. And that's why, you've got to pay attention, because the gold price does tell you that there are geopolitical or economic risks. They may not materialize, but
right.
The geopolitical risk index is fairly high and persistently high.
All right, folks, GLCO, that is the function of the day. Gives you all the global commodities. You click on the metals, and then it breaks it down between base metals, ferrous metals, and precious metals. So there you go. That's the function you need to be on top of what's happening in the world of commodities. James Steele, thank you so much. We appreciate it. James is Chief Precious Metals Analyst at HSBC. Whenever we see big moves in precious metals, by far, the first phone call we go out to is to James Steele, and he's kind of to give us some of his time there. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Alexis Christopher sitting in for Tom Keene. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. I can see on one of the other networks that Paul Stani Phil, the beast is out. So I'm not sure if the beast has seen its shadow or not. We'll bring that to you as that news breaks. Let's get back to these markets here today. Madison Faller joins us, global investment strategist at JPMorgan Private Bank, located in London. Madison, 2025, great year for equity markets. The U.S. equity markets did really well. A lot of markets outside of the U.S. did even better. How are you thinking about global equity stock price performance in 2026?
Sure. So I think, of course, 2025 was an incredibly strong year for markets broadly, and also for ex-U.S. outperforming the U.S., which is not something that we always see. As we look forward into this year, I think it's another story where we are very much focused on being globally diversified. We still do believe that the U.S. should remain the core of portfolios, given the access to growth and technology and potential productivity gains that it can provide. But at the same time, we are also seeing a world where national champions across different regions are also growing in increased focus, especially as it's underpinned by fiscal stimulus efforts, and that's also starting to show through into the earnings momentum as well. So I expect, a continued narrowing of the gap between the U.S. and the rest of the world, especially when it comes to earnings growth heading into this year.
In Madison, we keep talking about broader market participation with our guests, and we're seeing more and more of it. Which sectors, regions are sort of your top pick outside of the usual big tech names?
So when we look across the market, there are a few different things that I would call out. And I think that different regions are showcasing that they have different strengths that they can offer. So in the US, yes, you mentioned we do like big tech, but I do think that there's a broadening out beyond that to where we want to be focused on the entire AI ecosystem. So not just the hyperscalers, but the entire AI value chain, from the hardware to the software to power to data center infrastructure. But you're also seeing support within the U.S. Around financials and a catch-up from healthcare, for instance. In Europe, I think it's very much a focus on energy security, on defense. We do know that spending continues to become unlocked in that area. When it comes to emerging markets, EM can't be, I think, painted with one broad brushstroke, but there's certainly a lot of opportunity there where it be broad India, which is a focus of ours, in addition to China tech. And I would also call out Taiwan and Korea as well in terms of areas of focus within Asia. Breaking news here. Punxsutawney Phil predicts 6 more weeks of winter. I guess that should be no surprise. Although I have 2 of my offspring are in California, and they both were texting me like from the beach, from the golf course. Well, that's just nasty. That's just mean, yeah. Madison, talk to us about the bond market. Again, fixed income results in 2025 were really, really solid. How are you thinking about opportunities in fixed income in 2026? When I think about fixed income, I think what I would be looking for are carry-like returns. I think that now that we have most developed world central banks that are wrapping up their easing cycles, I do expect that bond yields will stabilize around these more elevated levels. And as a result of that, I think that we can expect to clip that carry as we move along. Of course, if we were to be in a more downside growth scenario, bonds could offer protection. But I think at the flip side of that is that if we do see more inflation volatility, bonds might not be enough, which is why we're very much focused on complementing that with real assets like infrastructure and commodities like gold, especially on the pullback. What are you doing with this gold trade right now? It went up so fast. I guess we shouldn't be too surprised, Paul, right? That it's violently the violent move to the downside. But do you, if you have gold, do you stick with it right now? Or do you just hold? If you're not in it, do you forget the FOMO and stay out for now? What do you do with gold? We're buyers here. I think that this pullback offers another, re-entry point for investors, especially if they aren't allocated already. For those that are allocated, we'd certainly be holding those positions. And I think you mentioned it. I think there's a little bit of a sentiment-driven effect that's driven prices lower over the course of the last few trading days. But I think the structural drivers very much remain in place, whether that be this continued uncertainty premium, whether that's debt, fiscal, whether it's geopolitically driven. But at the same time, we know that there's a lot of central bank buying. Retail buying is also not, I think, too elevated and remains below 2020 highs that we saw during COVID. So I think the seeds are still there. We'd certainly be buyers, and we actually just recently moved our targets higher, north of 6,000. Madison, we're just kind of right smack in the middle of earnings here. I guess to date, they've been pretty solid. What are you taking away from earnings, and what do you think the market needs to see from an earnings perspective here? I think the market needs to see that corporations can continue to, push through a lot of the unknowns that we've seen take place, certainly over the course of the last year. And so I think for me, it's more, whether or not they can really continue to show that resilience. We are looking at Q4, looking to produce, just under 12% year-over-year earnings growth, which is yet another quarter of double-digit profit growth, which is really meaningful. And on top of that, we're also seeing that profit margins are especially resilient and are historically high. So we're looking to see whether that continues to be the case. But the second thing that I would also point out is, how this continues to broaden out between sectors. So we know that the earnings growth gap between, the big tech, players of the world and the rest of the market was still quite wide in 2025, even if it narrowed a bit. We're looking to see if that continues to narrow. And so far, that does seem to be the case, with other sectors certainly starting to participate more. I have exciting news. I'm looking at my weather app, and it's hit double digits. So here in Midtown Manhattan, it is now a balmy 12 degrees. Madison, what is it like by you? Are you in London? I'm in London, and it is cold and dreary and rainy. And I must say, I'm originally from Florida, so when you're talking about the weather and pictures of sunshine, that's something that I certainly miss and I see from all my family members back
You're also
home.
a graduate of the University of Notre Dame, so you're no stranger to harsh winters, right?
Correct. Correct. I felt all the climates.
Madison, thanks so much for joining us. Appreciate it. As always, Madison Faller, Global Investment Strategist, JPMorgan Private Bank. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're joined now by Joe Davis, Global Chief Economist at Vanguard. Joe, I want to start with our Federal Reserve. We've had a lot of news over the last week. The Federal Reserve kind of staying pat with their rates. But now we have the nomination of a new Fed chair. I'd love to just kind of get your Fed thinking these days from a 30,000-foot level.
Well, again, I think it's really a good choice just from what I know of just past track records. And our view was that the Federal Reserve, may ease once in 2026, but it would be GDP growth that could eventually add a little bit more heft to labor market, which is pretty much stalled. And so I think we'll see that over the course of this year. Again, we could have surprises on the jobs front. So, but again, overall applaud. And I think the financial markets would agree.
Joe, I want to talk a little inflation in 2026. Last week, we got a backward-looking number as we continue to play catch-up from the government shutdown. We got the December producer price index, and inflation at the wholesale level was hotter than expected. What are your expectations for inflation this year? And I wonder if the tariff pass-through is now behind us, because nobody's really talking about it anymore.
I know. Well, again, it was delayed. It was never dead, the tariff pass-through. And so we should see some moderation in inflation. So the progress should be good, yet frustrating. Again, that's not, that's certainly our view. It's others' view, I think, as well. It's been stubborn. Inflation, it's almost 5 years above target. And again, I applaud, Kevin Warsh. I think he's pointed to a fact that we found in our research. Fiscal easing or easy fiscal conditions have some modest boost on inflation. I think that's one of the reasons why it's been stubborn.
What is your call about inflation going forward here? Because again, it's been persistent, sticky. One could argue that this one big beautiful bill may result in maybe even pushing inflation a little bit higher. How do you think about that?
Well, I think what will happen in 2026 is going to be the key, tension for the next 3 years. And that is, can AI and some of this productivity advances we've seen be a relief valve on inflation versus if we don't have those sort of dividends, you're going to have, some fiscal-based price pressures. That really is the tug of war we see, not just for this year. This year it's more modest, but as you're bold enough to look out 2 or 3 years, that is the tug of war. Can we get lower inflation with high growth or the inverse? That is clearly what I think the gold prices versus tech stocks point to on any given day.
Joe, growth at 4% is pretty darn solid. Is it sustainable, though, for the rest of the year?
Well, I think we have some one-offs. So we obviously had some trade, volatility that boosted the current numbers up. But our view was for 2026 remains intact, and that is we could have economic upside from the U.S. economic perspective, really driven at the margin by greater business investment and resilient consumer. We were talking about, the risk above 2. Now, we're clearly above that. We will see some moderation, but our thesis of economic upside, despite market froth, which gives us some concerns, that core message remains intact.
Hey, Joe, the labor market, I guess, one could call it resilient. Doesn't seem to be a lot of hiring, doesn't seem to be a lot of firing. Yes. Maybe that's okay. How do you think about the labor market?
Well, again, we've had supply and demand move down in lockstep. So clearly there's been a cooling from a hiring perspective, but we have one of the deepest labor market signals in the world, given our 401k record-keeping service. Millions of real time. We can see in real time how many are being hired, let go, and also their wage increases. And so what we see is affirming at a low level. Wage growth is stronger than employment growth. And if we're right, we should see a little bit greater vigor in the labor market in the back half of the year. But we're not out of that yet. I mean, we are prepared to see in some month a modest negative non-farm payroll. That's that break even with the supply having coming down. So that I think could be some market nervousness. You could see a Federal Reserve easing into that in between now and the summer. But if you're bold enough to look past that, we see some firming in the labor market.
Joe, thanks so much for joining us. Really appreciate getting a few minutes of your time. Joe Davis, he's Global Chief Economist at Vanguard Group. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Alexis Christopher sitting in for Tom Keene this morning. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio in New York City. We're streaming live on YouTube as well. Well, the U.S. government stumbled into a partial shutdown while waiting for the House to approve a funding deal President Donald Trump worked out with Democrats. Let's get the latest reporting from what's happening down there in D.C. We go to Henrietta Treyz, co-founder of Veda Partners. Henrietta, when are we going to get this partial shutdown, partially reopen again?
Yeah, that might be what it is, a partial reopening. We are looking at votes tonight in the Rules Committee around 4 o'clock, maybe movement on the House floor around 6 p.m. at the earliest, but Speaker Johnson is setting the table for Tuesday votes. So it's going to be a little while yet. I think we are on a path towards reopening, but you should expect some drama on and off today.
So what's the sticking point here, Henrietta? Is it still about immigration, ICE, and how, the White House is dealing with all of it?
Yeah, definitely. And I think more than just the technicals and the policy, we'll fight that fight for the next 2 weeks over masks and IDs and videotapes and stuff for all the ICE officers. But right now, it's really about the House Democratic Conference getting socialized the idea that they're going to need to provide quite a lot of votes to this, and Speaker Johnson accepting that. So Leader Schumer and President Trump were able to negotiate a deal that would work on the upper chamber, but now, the House has to weigh in. What I look at from the inside is where members who are not Hakeem Jeffries are. We're not on the far left. You have guys that are stalwarts in D.C. like Steny Hoyer and Jim Clyburn saying that they want to support the bill and they're encouraging their moderate members to do so. I suspect you'll see, much like in the Senate side, a good chunk of bipartisanship to get this over the finish line later on this week.
Henrietta, I believe the polling suggests that most Americans do not approve of the tactics ICE is employing here. How does that translate into what some of these Republican members of Congress do in terms of maybe this vote and maybe pushing back on some of the other president's agenda items? Where do we stand there?
Yeah, it's amazing. Everything is just broken right now. So you can't just say up and down, this is a red versus blue issue or a D versus R issue. You have members up for re-election in Texas who saw a 31-point swing in a state Senate seat just this weekend. That's crazy town. Wow. So you start to then fracture what would otherwise be a unified Republican or Democratic base. President Trump is going to do some serious arm twisting on, I would say, at least 30, 40 members of the Republican Party to get them on board with this package. And on the Democrat side, you're going to have to see a lot of movement into the realm of being willing to negotiate with Speaker Johnson and with the White House. So it's the Wild West out there right now.
I just want to broaden this and go international for a moment, Henrietta, because things are heating up here. It's worrying between Iran and the U.S. I know that over the weekend, Iran's supreme leader warned the U.S. of what he called a regional war. He said, quote, the Americans should know if they start a war this time, it will be a regional war. Talk to us a little bit about that. And where do things stand right now?
Yeah, I mean, military advisors will tell you that that's a posture that Iran must take on domestically because they do not have the firepower to go against the United States one-on-one. So they need to turn it into a regional theater. And what has occurred, obviously, as a result, because so many folks in D.C., myself included, are worried about escalation on the military front, some sort of kinetic event where we are in Iran or somewhere nearby. We know the USS Abraham Lincoln is in the region, prepared to do what it was not prepared to do, a week or two ago. So things have absolutely escalated. But the United States Senate already has members who are out there trying to put a war powers resolution on the floor to limit the president's ability to go to the next level with Iran. So I think there's going to be a sustained push that the president can't avoid. He doesn't get to just act in a vacuum here, like perhaps was the case with Venezuela. Now members are very keen to what's going on. They do not want to see another regional war in the whole of the Middle East. That does not play well with the American public. And Republicans don't want that on their backs going into a midterm election cycle either. So a lot of oversight that we did not see earlier in the year with Venezuela.
So we were going into this election year, Henrietta, thinking that perhaps Democrats could get control of the House. And then we see this state race in Texas that you mentioned, which was a real surprise win for the Democrat there. What's the feeling on the calculus for midterm elections here so early in the year?
Yeah, I mean, in this Texas seat, you had a plus 17 for Trump electoral outcome. And I want to say that now it would swung back to plus 13 for the Democratic candidate over the weekend. That is absolutely not normal. That is obviously the trajectory of what you see in a wave election cycle. It builds off of what Democrats were able to notch as wins across the Northeast in November and Georgia and Mississippi around the same time as they were doing the governor's races in New Jersey and Virginia. The message is really quite clear. I thought Senator Tillis had a really important point for Republicans, which is, the House is very likely to switch to Democratic control. We're at like 85%. On the Senate side, though, our odds are much more muted at 30%. But look at the fundraising in a race like Alaska, where the Democratic challenger raised, $1.5 million in 24 hours, which is more than the current incumbent Republican raised all quarter. There is galvanization and enthusiasm, and it's coast to coast. I mean, Jersey to Alaska, you can't get more inclusive than that.
Exactly. Similar types of weather, though. Henrietta, thank you so much. We appreciate it. Henrietta Treyz, co-founder of Veda Partners.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.